Hey, Richard here, and today we're going to talk about stock crashes. And we're answering a common question: where does the money go when stock prices fall or when the stock market crashes? Now, I've talked about what to do when the stock market crashes in a previous video, so if you want to learn how to take advantage of a stock market crash, you should definitely check that one out. But in this one, I want to talk about how it actually happens and also answer the question of where does the money go when stock prices fall? There have been a number of stock market crashes throughout history. And although each one has been a unique circumstance and situation, ultimately it comes down to one of two things, and usually a combination of both. The first thing that can cause stocks to crash is an unexpected event which triggers panic. An easy example to look at of this is the beginning of 2020 in February, March, when all of a sudden there was a global pandemic which caused people to panic. And these panicking people were afraid that the stock market would crash and decided to sell their stocks in anticipation of that happening. And this selling pressure caused stock prices to fall, which increased the level of panic and caused even more people to sell. So that's how it can happen on a global scale, but even individual stocks can crash because of some unexpected news event, for example, that's specific to that company or the industry that it's in. There could be a press release put out about a new lawsuit against a company, for example, which might scare some of the owners into selling their shares, which in turn causes the price to go down, which in turn may cause more people to get scared and sell because they're seeing the price go down. Does that make sense? Now, it's worth pointing out, by the way, that often when prices fall drastically because of people panicking, they can often fall by an amount that is disproportionate to how much they rationally should fall. And so although the value of the company may have decreased because of whatever the news event has revealed, oftentimes the amount by which the value has decreased is actually less than the amount that the stock price subsequently goes down by. For example, maybe the value of the company goes down by 10%, but the stock market overreacts and the price ends up temporarily dropping by 25%. And sometimes even news which causes big price drops from panic sellers can be news which actually was completely immaterial to the company's long-term prospects and really changes nothing about the company's true value. Yet a little bit of panicking can cause the price to drop. Sometimes it's not even necessarily panic selling that sets things in motion, because a lot of the participants in the market, I would say the majority, aren't focused on the fundamentals of the business behind the stock at all. They're purely focused on making profits from short-term price movements. And so some news might come out and the traders anticipate that other people will sell. And so they go ahead and they make a short sell trade looking to profit by the stock price going down. And if enough people are anticipating the same thing and follow suit, then the price will in fact go down from that selling pressure. And this price action might cause others who own shares to sell because they're seeing the price go down and they just want to avoid losses and they're afraid it might continue to go down. Is this making sense? So the bottom line here, though, is that sometimes stock prices can be driven down below what the actual underlying value of the stock is. And this, of course, can be a great time to buy some undervalued stock because sooner or later that stock price will rise again and trade in and around its true value once again. Warren Buffett's teacher, Benjamin Graham, would say over and over again that in the short run, the market is a voting machine, but in the long run, it's a weighing machine. And it's because there are these two participants in the stock market. The short-term focused people who are looking to profit from short-term price movements, and they're making decisions based on thinking about what other people might likely do, whether they're going to buy or sell, in the short term. And then there's the long-term focused people who are simply using the stock market to buy a percentage of ownership in companies at sensible prices. It's pretty cool, right? Now, the people in that second category are actually pretty happy with the fact that most of the people that are in the stock market are in that first category of being short-term focused. And that's because it's because of this that stocks can become undervalued. But here's the flip side, and this is the second cause of most stock crashes. It's something called bubbles. So just like how the stock market can overreact on the downside and temporarily price stocks below what they're worth, usually because of that chain reaction of panicking and selling, causing more panic and more selling, well, the stock market can also misprice stocks on the upside, or in other words, overvaluing them. So rather than it being a process of panic and selling, it's a process of basically over-enthusiasm and people chasing stocks that are going up in price without much regard to the actual value of the stock, and really just generally a fear of missing out. And a lot of what is fueling it as well is just an overall misunderstanding of what shares of stock even are. There's this great book on this subject, by the way, called Irrational Exuberance by Robert Shiller, which is definitely worth checking out. In the year 1999 and 2000, the dot-com bubble was mostly fueled by excitement about this new thing called the internet. People started buying up shares of all kinds of new and exciting internet companies, many of which didn't even have a business plan or a product, let alone any revenue to speak of. Now, from the summer of 1998 to the height of the bubble in March 2000, the NASDAQ had tripled, and everyone watching as it was happening wanted to get in and not miss out. People were literally maxing out their credit cards so that they could buy stocks. And eventually some rationality started to kick in, and it's not exactly clear what the catalyst was. Some people suggest that it was this article by Barron's that really started it. But regardless, once people lost confidence, it became an avalanche of selling. Now let's shift gears now and answer the question, where does the money go when stock prices fall and when the stock market crashes? And to understand where the money goes, it's important to understand that when you buy shares of stock, you're buying them off of whoever currently owns those shares. And that money is not going directly to the company. It's going to whoever you're buying the shares from. That's a common misconception that people think buying stock means you're giving money to a company. And that's not how it works. The money that's leaving your pocket when you buy shares is not going to the company, it's actually going into the pocket of whoever you just bought the shares from. So this is you, and this is the company, and these are the shareholders. And now let's say for one share of stock in this company, the current market price is $100. And here's a historical price chart that tracks what this share has traded for in the past. Now we've made no mention, by the way, of what the value of the shares is, just what the current price is. Let's just say though that it's overvalued, and that the intrinsic value of the share is somewhere below $100. So this shareholder here, he paid $80, so he would have an unrealized profit of $20 per share. This shareholder bought back here, so the price they paid is $90, so they would have an unrealized profit of $10. And this guy bought back here when it was trading at $110, so they have an unrealized loss of $10. And here's you. You don't own any shares yet, and let's also say that you're a total beginner and you don't really know how the stock market works, but your friend told you about this stock and they said they've made a bunch of money already, and now you've watched it come down from $110 to $100, and so now you think that it must be a good time to buy. You place a limit order for $100 to buy 10 shares for a total cost of $1,000. Meanwhile, one of these shareholders over here is thinking the opposite of you. They're thinking that the price is too high and they want to take their profit and get out. And so what they've done is they've made a sell order at $100 as well. And because both of you want to trade at $100, a transaction is made and your order is filled. You get the shares and they get the money. Because the transaction happened at the $100 price point, $100 becomes the last price for the stock. And by the way, whenever you pull up a stock quote, what you're looking at is the last price. The quoted price of a stock is always the last price that it traded for. Now in reality, those shares that you're buying could be coming from a handful of people. So you could be getting 5 shares from this person, 2 from that person, and 3 from this person right here. Nonetheless, you now own the shares and the sellers have the money. They're gone. They do their own thing. They might buy more shares of a different stock, or they might just go out for dinner. It doesn't matter what they do with the money now. Some of them had a profitable experience and some of them may have ended up with a loss, but it doesn't matter what happened to them. Now let's say some news comes out and some of the shareholders interpret it poorly and decide that they want to sell because they think the price is going to go down. They start selling, and because there are more sellers than buyers at the moment, the sellers need to place their orders at lower prices in order to find a buyer. So this guy might put a sell order in at $99, but that order does not get filled because there aren't any buyers at that price. So maybe they then move their limit order down to $98, where there is a buyer, and then their order does get filled. So $98 is now the last price of the stock. And now you are sitting there with an unrealized loss of $2 per share. Supply and demand is really dictating the price. Because there are more people selling, supply, than there are people buying, that's the demand, you watch as the price that the transactions are happening at become lower and lower until the point of it reaching $70. So you're now sitting with an unrealized loss of $30 per share. And since you own 10 shares, it means you have an unrealized loss of $300. And so the question is, where did that $300 go? Well, it didn't really go anywhere. What happened is the market value of the shares that you own, as dictated by supply and demand, is simply lower than it was when you bought it. You could say that the person or the people that you buy your shares from are the ones that have that money. That's probably the best answer as to where the money went, but it's kind of like as if you bought a brand new car, drove it off the lot, and then shortly after that, you decide you want to sell your car and you realize that the price that you can get is lower than what you paid. Technically, you're sitting with an unrealized loss by holding on to that car. So let's say you bought the car for $10,000 and you actually end up selling it for $7,000. Well, then your unrealized loss becomes a realized loss. And you could say, where did that money go? And the answer could be that the car dealership has the money, but closer to the truth is that the market value of the thing that you owned just went down. Does that make sense? And can you see how a stock market crash is just this happening but on a larger scale? See, stocks are funny because they have both a market value, and that's the last price that you see, but they also have an intrinsic value. Intrinsic value comes from the fact that it's an asset which generates cash. And cash generating machines have value inherently because they generate cash. And their intrinsic value will be based on how much cash will be able to generate for its owner or owners in its lifetime. That's pretty cool, right? Now, if you learned anything from this video or you know someone that might enjoy it as well, please share it with them so they can benefit from it too. And now a natural next question that you might have might be, how does the company benefit from the stock market at all if all the trading is happening amongst owners and that money doesn't actually go directly to the company? So if you want to know the answer to that one, check out this video right here next. And also, by the way, I'm not a financial advisor and I'm not your financial advisor. I'm just someone that loves money and loves investing. And I'll see you in the next one.